So what happens to vertical spreads when volatility changes? Well, it's a good question, and it's one that we get quite often in this forum, and for good reasons. During periods of high volatility, such as we're experiencing now in mid-July of 2022, traders turn to vertical spreads, and for good reason. They will do it to reduce the cost of the otherwise expensive options during high volatility, or to mitigate volatility and skews. The problem is if you're buying options or vertical spreads during high volatility, there's a good chance that that volatility is going to revert back to the mean. Good chance it's going to fall. And what's that going to do to your vertical spreads? Or conversely, maybe you're buying it during low volatility periods and expecting it to maybe rise. How is that going to affect your vertical spreads, and how should you set them up with those expectations in mind? Well, good questions, and that's what we're going to look at in this video. Before we do, as always, please be sure to click like and subscribe. It helps to promote the channel and is definitely very much appreciated. So let's start with vega. Remember that vega is one of our Greeks, an output from a pricing model, and vega shows the sensitivity of an options price in relation to changes in volatility. So for example, if we have a $100 call trading for 5, and our broker's platform might say that it has a vega of 0.05. And what this means is that if volatility increases 1 percentage point right now, so in other words, let's say that it goes from 30% to 31, that's what's meant by 1 percentage point, that this option is going to pick up vega. So in other words, that $100 call will be trading for about $5.05. So that's just the original options price of 5 plus vega. And that's where we're coming up with the 505. On the other hand, what happens if volatility had decreased 1 percentage point, let's say from 30 to 29%? Well, now that $100 call would be trading for $4.95. That's just the original $5 price minus vega of 0.05. So we would expect it to trade for about $4.95. So once again, vega is just showing how sensitive your options price is to changes in volatility. So once you understand that, it's now time to take a look at the vega sensitivities. Understand that your at-the-money options have higher vegas. All else being equal, it's the at-the-moneys that will have the greatest vega numbers. Longer dated options will have higher vegas as well. And so yes, that means if you are trading at-the-money leaps, let's say, something that has more than 9 months till expiration, but especially if you're going out a year or 2 or closer to 3 years, they are going to have absolutely the highest vegas. They will be the most sensitive to changes in volatility. If you're looking at your broker's platform, it's the at-the-money options and the longer dated ones that are going to have the largest vegas. Now, once you understand that, we can now look at the relationship of volatility versus time. Remember, volatility and time have similar effects on options. By similar, I mean that they move your options price in the same direction, not to the same degree, but you can, in a way, think of volatility and time as being the same thing. And what I mean by that is that increasing volatility or increasing time gives better chances for the stock price to move. So if you have an out-of-the-money option, there's a better chance for it to go in the money if you bought a longer dated option, or if volatility happens to increase. That's what this is saying. There are two different ways of saying that the stock price now has a better chance of pushing that option in the money. And so what that can mean, for instance, is that your out-of-the-money options have a better chance to move in the money. However, the flip side is also true. Your in-the-money options have a better chance to fall out of the money. Because once they're in the money, or in the case of vertical spreads, once both of those options are in the money, we'd love to see that be at expiration so that we've got a very high chance of that vertical spread expiring with maximum value. Or we could see volatility fall, and that would do the same thing. So those are really the important relationships to understand how volatility is going to affect your vertical spreads. And the reason is that you have a long and a short option. That's where things can get tricky. So for example, let's take a look at a vertical spread. And here we've got the 100, 105 vertical. So as always, I point out we get these bends right at the strikes. Now this profit and loss diagram looks a little odd because it's all sitting above zero. You can see that this point of maximum loss is lined up right here at zero. This is actually what's called a payoff diagram. And what this is assuming is that we paid zero for the spread. And the reason that I did that for this video is that as the volatility changes, it would change the valuations of the options. And so now it becomes a little difficult to see exactly what's happening with changes in volatility. So let's just pretend that they all cost zero, and that way it will give us a better look as to what's happening when we change volatility. So this is the expiration graph, what we look like when there's zero time on the clock. But let's say that we had this vertical spread at 20% volatility with 30 days until expiration. This is what our current curve would look like. This lazy S shape in green, fairly steep deltas through here. Well, what's going to happen if we have 40% volatility? Is this green line going to shift upwards over on this part of the graph, or will it shift down? What about over on this side? Is this green line going to shift up, or will it shift down? So if we move from 20% volatility here in green to 40, what's going to happen is this. This left side will shift up, and the right side shifts down. And then finally, what would happen if we went from 40% to 60? It's going to be exactly the same thing. You're going to see this blue line shift from its current position to this. So again, this part that's out of the money is going to shift up, and the part that's in the money will shift down. So remember what we've done here. In green is 20% volatility, blue is 40%, and red is 60%. And so if you look what happened as we increased volatility, going from the green to the red, going from 20 to 60% volatility, the part of the graph that's out of the money, meaning that the stock price is somewhere here below our long 100 strike, it's going to shift upwards. And the part that's in the money, if the stock is up here above 105, you're going to see your risk graph shift downward. It's going to shift from green towards red. So why is that happening? Well, again, what we just talked about, if the option is out of the money here, your long position, and volatility increases, it now has a better chance for this spread to expire in the money. And if there's a better chance, it's therefore more valuable. So the spread used to be worth this number down here, maybe at 50 cents, and now it's moved up to $1.50. Even though the stock price didn't move, we're just changing volatility. Conversely, over on this side of the graph, we would prefer to see volatility go to zero or time go to zero because we're at the maximum level for the profits. But if we increase volatility from 20% to 60, that's going to be a bad thing for it because it's now less likely for this vertical spread to expire in the money. And that means it's going to move from this valuation down towards the red. So obviously, if we have falling volatility, we're going to get the opposite. The left side, the part that's out of the money, is going to become less valuable. You're going to see that risk graph shift lower. And if you're in the money, both options are in the money, you will see that this side will shift upwards. And once again, the reasoning should be fairly clear. Once both options are in the money, we'd either like to see time go to zero or volatility go to zero. Push us right there to the maximum gain. And so that's what's happening as we move from 60% volatility in red to 20% in green. It's becoming more valuable provided that both options are in the money. But if we're out of the money over here, there's a lower chance for this spread to be in the money, and so the market is now putting lower valuations on it. That's what happens when you have changing volatilities. So what's the moral of the story here? Well, when you're putting your vertical spreads on, you need to take this into account. If you are in a low volatility environment and expecting it to rise, you might want to buy an out-of-the-money option because now you can pick up this effect here and you've got a better chance for that stock to in fact move into positive territory. And that's going to be a much higher profit position provided that you're correct. On the other hand, if you're already in a high volatility environment and you're looking to put this vertical spread on, you might want to consider pushing both of these options in the money, put the strike so that the stock is up here somewhere. And that way, if volatility does fall, let's say from the red towards the green, you're getting this added benefit. You're watching this spread appreciate in value just because volatility is falling. And so those are a couple of points to keep in mind whenever you're buying vertical spreads in periods of high volatility. And so for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a technical analysis course. You can find it all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.